They told you it was a simple stock market crash, a hiccup, a natural correction. But what if the official story is a lie? What if the prosperity of the 1920s wasn't real wealth, but a house of cards built on an illusion designed to collapse? And what if the very same illusion is happening right now, hiding in plain sight? The inflation eating your savings, the debt crushing your future, the job insecurity that keeps you up at night, it's not just bad luck, it's engineered. A cycle designed to transfer wealth from you to them. Where are you watching from? Drop a comment below and hit that subscribe button for the unfiltered truth. Because today, we're exposing the forbidden history of 1929 and the silent mechanism that's already guaranteed the next economic collapse. Cast your mind back to the Roaring Twenties, a time of unprecedented innovation, boundless optimism, and a booming stock market where everyone, it seemed, was getting rich. Factories hummed, new technologies emerged, and the American dream felt tangible. People borrowed heavily to invest, fueled by the promise of endless growth. Sound familiar? The narrative pushed by the financial elite back then was simple: prosperity for all, just keep investing. But beneath the surface, a dangerous game was being played. Banks were lending money hand over fist, not always to productive businesses, but often to speculators. They were packaging these loans, selling them off to other institutions, effectively creating a daisy chain of debt. Sound familiar? This seemingly endless supply of credit inflated asset prices far beyond the real value. The economy looked robust, but it was hollow. The real economy, the one based on tangible goods and services, was slowly being decoupled from the financial economy, the one based on speculation and leverage. It was like building a skyscraper on quicksand, disguised by a gleaming facade. The foundations were rotten, but no one wanted to look too closely because everyone was too busy making money, or so they thought. Sound familiar? This wasn't just a simple bubble, it was a systemic vulnerability being built brick by engineered brick. The official history books point to October 1929 as the moment the party ended, a sudden, inexplicable crash. But what if that crash wasn't sudden? What if it was the inevitable consequence of a financial weapon deliberately unleashed? A weapon so complex, so insidious, that its true nature remained hidden for decades, only to resurface in new, more dangerous forms. This weapon wasn't a stock or a bond or even a simple loan. It was a promise to pay based on the future value of something else, something intangible, a bet on a bet. It was the birth of what we now call the derivatives market, specifically the unregulated explosion of synthetic instruments within the burgeoning shadow banking system. These weren't traditional assets. They were agreements, often off-balance sheet, traded in the shadows, amplifying risk beyond anything ever seen before. And the key figure, the architect who understood how to harness this dark potential, pushing for less regulation and more opaque trading, his name and the institution he helped build will shock you. The actual evidence is crazier than you think, and it reveals how a small, powerful cabal engineered not just a collapse, but a permanent power shift. Let's peel back the layers of this financial deceit. Imagine a farmer betting on the price of his crops. Simple, right? That's a basic derivative. But what if a speculator, someone with no crops, no farm, could bet on that same crop price, then bet on someone else's bet, and then buy insurance on that bet, even though they own nothing? And what if these bets were so complex, so interconnected, that a single bad wager could bring down an entire chain of institutions? That's the core of the shadow banking system and the derivatives nightmare of the late 1920s. They were creating synthetic assets, financial instruments whose value was derived from something else, not from real-world production. Think of it like a chain letter, but instead of sending money, you're sending risk. The more links in the chain, the more precarious the whole structure becomes. Banks, desperate for higher returns, started investing in these opaque instruments, often using their depositors' money. They sold over-the-counter, OTC derivatives, unregulated contracts traded directly between parties, far from the prying eyes of regulators. This was the Wild West of finance, where secrecy was king and accountability was non-existent. Here's the chilling truth. By 1929, the estimated notional value of these derivatives, especially those tied to commodities and obscure indices, was already approaching 10 times the size of the entire US GDP, an unimaginable leverage. When the underlying assets dipped even slightly, the cascading effect of these highly leveraged, interconnected bets created a panic. It wasn't just a market correction, it was a systemic implosion triggered by the very instruments designed to diversify risk. Take, for example, the widespread practice of buying on margin during the 1920s. Investors could buy stocks with as little as 10% down, borrowing the rest. This was effectively a simple derivative, amplifying both gains and losses. But when prices began to fall, margin calls flooded the system. Brokers demanded their money back, but investors had none. This created forced selling, driving prices even lower, triggering more margin calls, a vicious feedback loop. The illusion shattered, revealing the fragile, debt-laden foundation beneath. The true horror of it? The scale. By late 1929, an estimated $50 billion in paper wealth evaporated in a matter of weeks. But the real damage was the destruction of trust, the loss of real capital, and the unleashing of a depression that lasted a decade. This wasn't an accident. This was a blueprint for engineered destruction, a moral hazard institutionalized, creating parasitic finance that feeds on the unsuspecting. The greed of a few, enabled by an opaque system, devastated millions. The architects of this system understood that if they controlled the mechanisms of risk, they could profit from both boom and bust. What makes today even more terrifying is that the very same derivatives market, the same shadow banking system, is 50 to 100 times larger than it was in 1929. We're talking about a notional value estimated to be over $1 quadrillion. It's a global web of interconnected promises, making the 1929 collapse look like a playground skirmish. The stakes are infinitely higher. They learned their lessons from 1929, how to control the narrative, how to bail out the powerful, and how to make the public pay for their gambles. They've built institutions on borrowed time, on the denial of inherent risk. We are walking a dangerously familiar path, blinded by manufactured prosperity, ignoring the ticking time bomb of synthetic finance. Don't be a casualty of the next engineered collapse. Share this video, spread the truth, and subscribe for more insights that challenge the official story. Because the question isn't if the system will break, but when. And are we wiser now, or walking the same path in better suits?